Disney reporting a beat for its first quarter earnings. Joining us now with an investor's perspective on the numbers, Bill Smead, CEO and CIO of Smead Capital Management. Smead Value Fund, by the way, owns around $80 million of Disney stock. Bill, great to have you with us. What was your take on the quarter? And do you think, the knock on Disney stock is that investors want to see progress in streaming because that business is seen as the growth business that could offset the declines in the core business. Did we get any indication of that so far?
Well, we're long duration players, not short duration players. There's lots to like for long duration players in here. Remember, Melissa, that the thing about the Disney Corp is a child is born in the United States and they're almost automatically a customer of the Disney Corporation. So therefore, parks and movies and brands and characters just incredibly flourish. Because of the incredible goodwill attached to now 2 prior generations of family before they come. So they just want to make sure that they're organized well to provide those brands and those products to all the generations, all the ways they want them. And then the other side of the coin is in the capital markets the last 5 years, you were much more rewarded for spending money on things that would cause you to do well 10 or 20 years from now. So they just kind of took a time out a year or so ago and said, hey, we're not getting any multiple for our earnings and free cash flow. Why don't we make the investments right now that kind of fight off these threats to one side of our business?
So does that mean, going back to the original question, Bill, I'm not really sure if I got the answer, that you're seeing some signs of progress in terms of the streaming business to the point where you can feel comfortable in saying they're making the investments, as you said, for the right reasons, and we're going to see a return on the investments in the ability of Disney to offset the declines in the core business?
The answer to your question is that content is always king, and no one can touch their streaming content. So whether it be ESPN and, professional sports and college sports are going to ebb and flow to a certain extent based on the composition of our population. We have 60 million Gen Xers. We had 80 million baby boomers. So when the baby boomers were 35 or 40 years old, watching sports on television was at the absolute peak of popularity. Now we have 60 million instead of 80 million. So it's 25% less human beings that are going to be interested in that age group than there used to be. So that will change because the group behind them is 86 million people. Again, it's what you want to worry about in the short run. But the when you get right down to it, they have superior content in all those phases. And therefore, when whatever demographic is hot, for example, no one's been talking about the fact that they own 5 to 10-year-old kids. What are we manufacturing in the United States? Children of college-educated women, affluent. The average child's born into an above-average income household. And the grandparents have waited way long to have a child, longer than they've ever waited, and they're all just starving to take that 5-year-old grandchild to Disneyland and to hook them into the ecosystem that they have produced.
Yeah, Bill, there's no denying. Actually, parks was a real bright spot in this quarter. I think one of the things that perhaps is suppressing the valuation of Disney relative to its history, right? It trades around the broad market multiple of forward earnings at the moment, is that getting to those customers with those brands in this new way is just a little bit less reliable. You're not just sort of charging them a monthly tax through the cable bundle as we used to be before. So I wonder how you're reading this transition period and whether there's more financial risk, at least in the short term.
Well, you've already mentioned what the risk would be. Disney is a company that normally trades at a premium to other companies. It's pretty much a staple, and it trades at the multiple of businesses that are very greatly affected over the years by economic forces. So you've said it all right there. What is the likelihood that 20 years from now the Disney Corp is a massively successful company? And then what are you paying for that possibility of it being massively successful? And the answer is you're getting a great risk-reward relationship right now.
Bill, Jason Chenard here. I was wondering if you could just talk maybe from a more macro point of view about the pricing power at the parks themselves. For a lot of people, this is starting to get pretty high up on the in the paint cards as far as what people need to pay to go there. And I'm looking at it more from an economics point of view in terms of inflation and just an overall sense of consumer confidence. So can you talk a little bit about that?
Thanks, Jason. Great question. So I remind everybody, when Warren Buffett speaks to college students, he reminds them the worst thing he ever did was in 1966, he sold his Disney stock. Buffett says a great business has a mirror on the wall. And the CEO goes up and says, mirror, mirror on the wall, should I raise my prices this fall? And if it's a great business, the mirror comes back and says, why wait? And so if you looked into the numbers, they raised the prices in the park because they have got to find a way to regulate the number of visitors inside the park. You're going to ruin the experience for people if there's too many people in the park. The only way for them to regulate that through price. And by the way, for our political leaders and other people that regulate things like the internet, price is how you regulate things. So the answer to that is it worth $150 to go to the park? Is it worth $200 to go to the park? We don't. My guess is with 60 to 70-year-old people waiting for their first 5-year-old grandchild, there isn't a number anywhere near where we are right now that would interrupt that.